Stocks have rebounded smartly since mid-June, as U.S. inflation may have peaked and companies have reported better than expected earnings. Still, uncertainty over inflation's path and how central banks will react could mean more modest and potentially volatile equity returns ahead. Let's take a closer look. Indicators show that the U.S. Consumer Price Index may have peaked, which bond investors anticipated months ago. Some confirmation also came last week as the Producer Price Index actually fell 0.5% in July versus an expected gain of 0.2%. Commodities are leading the price declines. U.S. gasoline prices have fallen from a peak of $5 a gallon in early June to just under $4 a gallon presently. Global food prices have fallen 12% from their peak, led by a 40% drop in wheat prices as wheat exports from Ukraine have recently resumed. We expect prices to drop further because of slower economic growth and the rapid decline in money supply growth. However, our sticky inflation risk case remains a concern due to still strong labor markets and elevated housing costs. The U.S. labor report for July showed a shockingly high 528,000 jobs added, with average hourly earnings increasing 5.2% and an unemployment rate of just 3.5%. While there was some slowing in housing costs in the July inflation report, they still rose 5.7% over the prior year. Over the last month, the S&P 500 index has increased 11%, while the Russell 2000 index of smaller cap stocks has jumped nearly 16%. Looking forward, we expect more muted returns as our base case of 50-50 recession odds works its way into earnings and investor expectations. We also expect the inflation-wary Federal Reserve to focus on tighter monetary policy until it sees meaningful evidence of lower inflation. Core inflation in the U.S. was 5.9% in July, nearly triple the Fed's target of 2%. Inflationary pressures remain global, with recent inflationary reports in both the UK and Euro area near 9%. We expect market volatility to remain high as investors assess the path of inflation and the resulting reaction from global central bankers.